Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A warm welcome to our webinar this morning. We're thrilled to have Vince Pizzullo from Perpetual, who's going to help us understand what's happening in investment markets at the moment. Like our last seminar, the webinar that we ran in June, we're thrilled to have a significant level of registrations for this morning's event. Welcome to all our GFM clients who are joining us this morning, but also welcome to all of the guests that have decided to join our webinar. We're thrilled with the number of people who are wanting to hear about what's happening in markets at the moment. It's fair to say it's challenging times, not just in investment markets, but more broadly, the way we interact day to day. We're thrilled to have our clients of GFM dialing in this morning. We understand times are tough. We understand people are doing it a little bit harder. Being a Melbourne-based firm, we really do feel the challenges of COVID at the moment. By all means, if you ever need any assistance or you want any help, please feel free to give us a call. Last financial year was a tough year in the Australian share market. The share market lost 7.68%. This was clearly significantly impacted by COVID. Volatility is high, uncertainty is high, investor confidence is low. I'll officially introduce Vince in a moment, but fortunately we have Vince here to help us unravel some of these challenges of what's happening in investment markets at the moment and perhaps help us make sense of what's going on. Now, before I get underway with Vince, we've got our usual important disclaimer. Today's webinar is general in nature. This is not specific advice. If you are needing more specific advice, please feel free to contact our office or please feel free to call your advisor. Also, during the webinar process, we asked if you had any questions. Again, we were overwhelmed by the number of questions that were presented to us to ask Vince. We're going to do our very best today to answer most of those questions, but if we don't get round to answering all of those questions in the time allotted, again, feel free to contact our office and we'd be more than willing to answer those questions. So I'm thrilled to officially introduce Vince Pizzullo, Deputy Head of Equities at Perpetual and the Portfolio Manager for Perpetual Investment Company, an investment which many of our clients hold. Vince joined Perpetual in 2007 as an analyst and since that time has covered different sectors like chemicals, diversified financials, banking, telecommunications, building material and REITs. Prior to joining Perpetual, Vince was a Senior Portfolio Manager and analyst in the Australian equities team at Deutsche. He had stock research responsibility across many different sectors at Deutsche. He's a very experienced manager. Vince also has a Bachelor of Commerce with a major in economics and finance. So good morning, Vince.
Morning, Paul. Thank you. Thank you for the opportunity to speak to your clients.
Thanks, Vince. Look, the first question I'll ask is, would you mind providing a high-level overview of the Perpetual Investment Company, please?
Sure. So the Perpetual Investment Company, we listed the LIC, it's an LIC, listed investment company, in 2014, December 2014. And that was driven by a couple of the investment products we ran. We ran a very concentrated portfolio called, it was like an SMA style called Portfolio Separate Managed Account, about 20 stocks, which was a lot of mid and small cap stocks, but it was quite flexible and had a high cash ability as well, which we used to protect the portfolio for downside. But also, we've been investing in some global stocks as well in other portfolios. So what the Perpetual Equity Investment Company is it's a highly concentrated portfolio of stocks, the high conviction. So we do have very high weights in the stocks we invest in, up to 10 to 15% in any single name. And that's, you can see we just added a few things there. You can see it on the screen right now. It's between 20 and 40, but typically we try to drift down to the 20s to give it a bit more punch, the portfolio. And we can be between 50 and 100% in Australian listed securities if we see that's where the value is. 0 to 35% in global as well. And I just want to make mention, during the shutdown during March, etc., that used to be, for the last 4 years, it's been about 0 to 25%. But because we saw so much value on offshore, the board of the PIC and myself, we discuss this every year, what's the right balance for offshore versus domestic, because we're trying to maintain a growing income stream or a stable dividend stream And also, most importantly, is the franking credits out of that. If you go offshore too much, that can hurt your ability to do that sometimes because they don't pay frank dividends. So, but the board and I agree that we lift that up to 35% offshore because of the opportunities, and up, as I mentioned before, up to between 0 and 25% cash. So you can see the portfolio is very flexible, and that's by design so that we can protect on the downside when we can with having a high cash weighting when it's necessary, when we don't see a lot of value in the market. But also the way, because it's an LIC, as more importantly, is that we book all of because it's an actively managed account, we will take profit when it's necessary in some of our positions when we get extreme valuations. We'll generate profits on the position, which means you have to pay tax on that position. And because we book it through the revenue account, we can generate our own franking credits out of that. And that allows us to put into our profit reserve, etc., which allows us to build that buffer to pay future franking credits out as well. So the idea of the fund, the LIC, is to have a very flexible opportunity. Most of the time, this will be one of the investors' first forays offshore as well. So we have a large team of about 17 investing professionals within Perpetual, and we look at domestic and offshore stocks all the time. So we do all the legwork for our investors, and we only bring in the highest quality, what we believe best long-term investments we can find.
Fantastic, Vince. It's obviously been a challenging time to be a portfolio manager. Specifically, the falls in March when the market became acutely aware of the potential impact of COVID was very difficult. But since then, since late March, we've seen a very strong recovery. What do you think's been behind? What's been driving this recovery in investment markets?
So it was actually very interesting because every crisis is different. They all are. They all rhyme, but they are very different.
Yeah.
Sure. So this was obviously self-made. We specifically shut the economy down ourselves.
Yeah.
But what was different this time is everyone is now actually being conditioned to central bank intervention. Okay. In the GFC, it happened pretty quickly as well. It took a bit longer in a sense that the duration of the response. But now everyone's conditioned to rates go to zero, quantitative easing is commenced, cheap money, basically no bad debts will occur in that time, intervening period. But what was different about this time was the government response fiscally was rapid. It happened within a week. Okay. And actually the bottom of the market occurred just before, which is in mid-March, just before fiscal policy announcements and transfer payments were announced. Okay. Because the market hadn't expected the government to go universally, globally, all at the same time. They all decided to go heavy fiscal spending really aggressively. And that marked the bottom. And more importantly, what that allowed was a lot of industries, because of it was self-made, a lot of industries were going to be in trouble very quickly. So JobKeeper payments especially stopped wholesale unemployment, permanent unemployment, more importantly, to take hold. And don't forget with the market for periods, it has this duration issue. The market will look at the peak of every cycle, the equity cycle. The market can see forever. They have perfect foresight and they think they can forecast for 20 years. At the bottom, they can't see across, in front of their nose, basically. So the market is a discounting machine, and what happened was at the bottom, no one could see past the crisis, right? And this is where the opportunities arise. But once the government stimulus started coming in, people started to lengthening their view again about, okay, what does the recovery look like? And that's why you're seeing quite desperate sectors' performance. There's been quite a bit of differences in the way the sectors have performed. So initially, you saw very defensive, the Woolworths, the Staples, those sort of businesses. Healthcare perform extremely well, and tech, because tech, everything could be done online, etc. You didn't have to go out to buy their services. So people were basically buying very short-term certainty by buying those sort of companies. In our perspective, the right thing to do is to sell those and look at the other parts of the sector. And I'm assuming we're getting asked questions about the other parts of the economy. The opportunities were really starting to arise where we could see, in our perspective was literally, you've got to have a philosophy, and our philosophy is very anchored around quality and value. Okay, what quality companies are being thrown out with other companies that were less quality, but we could buy them at sensible prices. So that's where we were sort of looking in parts of the market which hadn't recovered yet. So the market's bounce, it was actually split between very known earnings, so staples like Woolworths, Coles, Metcash, and the healthcare stocks, as I mentioned earlier, and a lot of stocks were thrown out. So those other parts of the market were held up by those sectors. But now the market's now willing to look a bit further ahead, and you're starting to see rebounds in some of those discretionary sectors. You know, retail, like JB Hi-Fi, they're called the stay-at-home trades. JB Hi-Fi, Nick Scali, everyone went and bought a very cheap desk. So they had something to do at home. They're not on the dining room table. So that's sort of already happened, and that's where we are today. So now the issue we've got is we're trying to work out, there'll be some sectors that may never recover back to 2019 levels because of change in behaviour, permanent changes in behaviour. That's the art now is to work out where you want to position your portfolio, where you can get back to to 2019 earnings numbers as soon as possible.
Yeah, Craig, I'm keen to elaborate more, Vince, on some of those sectors in a moment. But you touched on the recovery, and I guess we're talking about shapes these days. We're talking about V's, we're talking about U's, we're talking about W's. How do you see the economic recovery playing out?
Well, at this stage, because of the persistence of transfer payments that the governments are continuing on with, job seeker, job keeper, that's changing a bit. The next round is obviously not as broad and less targeted. This round is much more targeted to those issues which have been influenced by government policy. So shutting down a border, that affects the travel industry quite severely, right? So you're going to get different shapes depending on which sectors you're investing in the market, right? So healthcare, it was a straight line. There was no dip at all. Behaviour hadn't changed. You actually had, like to call it an A. So you think about Woolworths, it went up because of pull forward of demand of pantry stocking, etc. That's very different. Where you want to be looking, in my view, is, and when you look at economic recovery, is the mispricing usually typically occurs in the sectors where the market can't forecast forward because to put it this way, no company's got any guidance out there anymore. No, and don't forget the government's, Josh Frydenberg said, you don't have to do continuous disclosure. Okay, you don't have to provide guidance, which is sort of plays into our hands as well, because we've got a deep team of analysts. We'll do the work for our investors because we always go, what's the mean reversion? Everything mean reverts to an average economic cycle. So there'll be some sectors which are W's, and I suspect there'll be a lot of the opening up trades, getting out of home type of, as we go into like a less restrictive lockdown. That's the W trade. It'll roll over a little bit, but we're going to normalise at some point next year in 21, 22. Construction and cyclicals, they are more V's because the banks are behaving a certain way regarding credit, the access to credit, and the economy relies heavily on credit creation. So cyclicals are relying on credit creation quite a bit to generate, people got to think, take a risk and buy a house to build one, etc. And infrastructure is sort of starting to roll over as well, the scale of the project. So it's all very dependent on the sector where you want to place your investments will determine the shape of VW or U. As long as there's not going to be any policy missteps, which is if we pull the rug from any sort of transfer payments too early. But I'm of the view at some point you're going to have to, because there's no such thing as a free lunch. We're going to have to pay for this at some level, and it's either going to be taxes or lower structural growth going forward. That's how we pay for these, because you are literally you're shifting demand forward by doing this by providing a lot of stimulus.
Yeah, couldn't agree more, Vince. I think if we think about sectors that have been really hit by what's happened during COVID, what immediately springs to mind is travel and retail. So I guess a two-part question here. Firstly, is there any way out for travel and retail, firstly? And secondly, or if things just change permanently? And secondly, have you purchased anything in these sectors? Did valuations get so low that it become compelling?
Yeah, so travel, very topical. Travel, let me walk back a bit. What the shutdown had done was, because it was so abrupt, like there's early warnings in a traditional business inventory cycle. You start to get overproduction. You start seeing cash flow performance in the economy, in companies become quite poor because they get left with, we were a period of excess demand to companies responding by producing enough product. Then demand starts to wane because usually rates go up or some other factor. You start to see cash flow performance become quite poor out of companies as they get left with inventory, etc. That's what we look for. There's always early warning signs in an economic cycle. This was like dead stop, right? So in the first example of a typical inventory cycle, companies can adjust gently. They don't stick the landing all the time, but they can adjust. This was literally day one, it stopped. So certain sectors have been found out structurally quite quickly, and to your point, travel's one of them. So a company like Flight Centre, which has a mixed model, has an omni-channel style business, but it was heavily weighted towards storefronts. Okay, now we've never really owned Flight Centre in the past because of this issue regarding the structural issues regarding the storefront, and that while they did still a great job, even they recognised they had to shrink the storefronts because it is a high fixed cost. It's a lease you can't get out of typically very quickly. It's usually a 5-year thing. And what happened to them was it was an abrupt stop to travel, and they got all these leases they have to keep paying rent on. Now there was rental forgiveness, etc. But the manager recognised all that structural shift that we expected to happen in 5 years is happening in a month. So they had to actually change their business model immediately. So they were on a gentle path to shift out of having more storefront, more online, to having to do it within a month, within 30 days. So they had a plan. They actually had a plan already, like a Flight Centre, to accelerate that. So we actually participated in Flight Centre they did a secondary market offer. We hadn't been on the register, and fortunately, because of the scale of Perpetual, we get the first call on a lot of deals, any sort of secondary market placements, and we were able to muscle in onto the deal, even though we didn't own any stock. So we got access to 3 or 4% of the PIC at $7.20. Okay, that was our entry price. 3 or 4%. It's now bounced. It got up to as much as $15. And I said to you, we actively manage it. We think the stock's probably worth at $18 to $19 longer term, but it was trading ahead of itself. So we did participate in some travel stocks. The other on retail, as you brought up, it is actually like there are some haves and have-nots. The haves, like I mentioned before, JB Hi-Fi, Nick Scali, Harvey Norman. We did buy some Nick Scali. Great business model, extremely good management, know their customer base very well. They control their costs. They control the factors of production as well quite tightly. And, their store economics are very good, and they're still opening stores. So when that fell to $2 to $3 for us, with a good balance sheet that it had, which is very very important to us, is the having a really safe balance sheet, because that gets you through these sort of events. We participated pretty aggressively in Nick Scali as well, so that's more of the recovery trade than Nick Scali. We're now out of it because it's bounced to over $6, etc. It's close to $7 today. And we're not trading it; it's just that it's now well above where we think fundamental value is. And we've rolled that money into other stocks. But to your point, we did participate in retail and travel. They're two very different trades, both recovery sort of trades, but we went for the ones where we always feel they've got a better business model and are likely to be a winner in 3 years' time.
Yeah, fascinating. That's really fascinating, Vince. In fact, it's making me think, we have companies that are quite cyclical to the economic cycle, and we have companies that are non-cyclical. And one of the observations, which I think you touched on earlier, was that some of these non-cyclicals that were heavily supported by the market, particularly with the onset of COVID, and many of these cyclicals appear to have been heavily sold down. So are there any other examples where potentially you felt the market mispriced these cyclical stocks and you ended up buying for PIC?
Yeah, so one of them, which is heavily cyclical and it's been around a while, is Boral. We were quite critical of the management's move into the US because they paid it's never usually a great idea to buy off private equity. Let me put it that way. You tend to, they run the business differently to a long-term owner. So you make different decisions about your business and regarding reinvestment, etc. So they bought off private equity in the US, these assets. They paid a lot of goodwill, and it's been quite disappointing, the performance. But during this period, the stock had fallen to well below the net tangible assets. So the NTA, this is traditional value investing. You're going back to straight Ben Graham investing, right? You can buy the business for inventory and assets, and a slight discount to that, you can usually win over the long run, as long as it's got a good balance sheet. So we're quite activist as well. So we will get and agitate for management change if we need to. Remember, the PIC invests along another $14 billion. So that buys us time in the room with the management and the board if we feel that they're not doing what we expect them to do in maximising shareholder value. So with Boral, once it trades at a discount to assets, and they are high in Australia, they've got some of the best hard assets in construction in Australia by a country mile. So great aggregate positions in most markets, very long concrete, so they can pull through the benefits of it being long aggregates. So that's a logistics business, concrete. It's a ready-mix business, and they're short cement, i.e., they don't make as much cement as they need to consume in their own business, which is important because we actually import nearly 60% of our cement comes from offshore now. So if you've got hard assets which are exposed to cement manufacturing, you're competing with imports. So the structure of Australian business is really good. It was just poorly run. Now, fortunately, we bought some at about $2, $2.10. It's about 4% of the PIC today. And the board's actually recognised so that they need to do a strategic review. We're hopeful that the board will recognise that being in the US, they've got no strategic benefit out of being in the US in certain assets. We quite like some of their harder assets in the US, but windows, roof tiles, those sort of businesses, bricks, they're not great businesses. So we're of the view that they'll probably exit that, and that if we can get anywhere close to book value, that's different to net tangible assets, book value, we're going to get $5, $6 out of it, out of the stock, and it's currently trading about $3.80. So we bought well because there was mad panic. As you said, they were overly discounted below the actual replacement value of the assets. So they're the opportunities we really look for. Another one we looked at, and it's on the screen now, is Le Français de Jeu. Hopefully I said that. I didn't offend any French-speaking people on the call. So what FDJ is, it's a recently listed, so it listed in November last year. It's the French lottery operator. It used to be owned by the government. It's still owned by about 22% by the government. Fortunately, the war veterans own another 14%. So you don't want to piss those guys off. They're very reliant on dividends, the war veterans. That's how they get their income checks, is through the dividend from FDJ. So there's a company we recognised earlier. We've been an earlier investor in Tabcorp over the last few years because the lottery assets are really good. Now, the thing about FDJ, which we looked for, and it really highlighted to us, it's got some structural advantages. Firstly, it's got a 25-year concession on the lottery. It traded during the lockdown because you literally couldn't go. Look, they sell their lottery tickets through tobacconists, news agents, mostly tobacconists, bars, etc. Okay, because you couldn't go out, you couldn't do any lottery sales. Now with Tabcorp, that's fine because they've got, I think they're about 35% penetration online in ticket sales. FDJ, it's only 2%. Now that's what attracted it to us, is that 2% online penetration is extremely low. Rest of in the Nordic countries, it's close to 75 to 80%. So when we spoke to management, we were trying to gauge, like, what is your view on online? And they're saying, look, we're under-penetrated. We want to move online. Now, why that's important is margins on online ticket sales are materially higher. Okay, you don't pay as much in marketing, etc. Pay a commission to the seller of the ticket, etc. You don't have to do that, and they've got a strategy around it. But what really attracted us to us as well was they produce lottery technology as well. So they produce the machines, the operating system for lotteries that operate, and actually to the point where they actually sell their lottery systems offshore into other markets in Canada and Europe, etc. So about a third of their staff are actually technology staff. It's a very, and they don't underinvest as well. More importantly, their R&D to sales is extremely high. And what really attracted it to us is they had net cash balance sheet. It was a $3.5 billion company, had $400 million of cash on the balance sheet, no debt. So that all lined up for us. Now, the opportunity arose during the sell-off is that it traded back to its IPO price. Okay, we were buying it at 16 times earnings, and it was paying us a 4.5% dividend. Yeah, that's very rare to get. And they've got a stated dividend policy of about 75%. So we actually took a real big swing at it. We took it up to about 8% of the portfolio. We're quite convicted on these businesses. We're now, the way we look at companies, and it might be interesting, your investors might be interested in this, is we always think about a 3-year valuation of the company and benchmark the strategy of the management against that valuation. There'll be a few things there where we're going to say, right, to achieve that valuation, we need margins to improve, or they need to take market share, or they've got a technological advantage that allows them to press their advantage against their competitors, etc. There'll be a few things which will be our investment thesis. Now, when we go through reporting, and every 6 months, they have a result. That's what we're assessing them against. Are they online? Are they on the path to achieving that? What we believe is a pretty big valuation improvement. And we don't try and bog down into the minutiae of results. Oh, the cash flow was 5% below. Well, cash flow is important, but they may have missed it for a little bit by 5%. As long as we speak to the company and understand why they missed. But that's where it provides opportunities. Is that the core investment case is upheld. Now, if something changes, there's a structural issue, that's when you change your mind. Okay. So at FDJ was a perfect example of that. Nothing had changed about the company. It had fallen 40%. Okay? We had an opportunity to buy it at a significant discount to our valuation. So that's when we had a proper go at it. 8% of the portfolio is a fair odd go at it. We're convicted by our in-depth industrial analysis that we do in-house. So that's like two very different types of companies. You've got one which is a bit more of a structural grower like a FDJ, and one which is a more deep, cyclical, opportunistic business cycle investment like Boral.
Yeah, Vince, this is fascinating. So, I can see from the slide that you had up there, 65% of the portfolio in Australian shares, and one of your strategies during COVID was to play what you believe to be the undervalued cyclicals. I'm fascinated with a part of the portfolio being invested in international companies. You mentioned the French lottery company. I'm not going to try and repeat its name for the French clients that are on the call, but how do you find a French lottery company within the resources of Perpetual? You obviously you said you've got 8% of PIC invested in that. There's two parts of the question. How do you find these international opportunities, and are there any other international stocks that you've got a high conviction with at the moment?
We've got recently we're very heavily weighted to the UK and Europe at the moment, because on a valuation basis, the US has done particularly well. US market's done really well. It's like been the best performing market globally, and the valuations there are a bit on the high side of where I'm comfortable. So we've seen quite a bit of value in the UK, and the UK is quite interesting as a market in itself, because they've been dealing with austerity literally for 5 to 6 years. And I was in the UK with one of my analysts in November last year. We did quite a big trip because the equity value there, it's one of the cheapest markets globally. And you could buy really high quality businesses at reasonable discounts to the rest of the global investment opportunities. So one of them, it's on the screen now, is Ferguson's. That is everyone in Australia, probably particularly in Victoria, I expect you all know who Reece is. Reece Plumbing Supplies. Great business. We've owned Reece for 22 years in a lot of our portfolios. Ferguson's is effectively the Reece of the UK, but it's actually the US. It's listed in the UK, but Ferguson's is like 15% of the US plumbing supply market and HVAC market. So heating, ventilation and air conditioning. And what attracted us to that was it was trading, when we bought it, it was trading on 14.5 times PE. We could get a valuation, it was trading at about £50, £55. We're getting valuations of £80, £85 because what they do in the US is I'll answer your question about how we found it. So, I just want to tell us something a bit about this company because it's very different to what we've, FDJ. So it's, to notice the differences is really important because you get balance in your portfolio. So Ferguson's are basically buying mum and dad little operations, plumbing supply business in the US, and they plug them into their inventory management system because when you're a distributor, your inventory management system is all you've got. That's your advantage. And they spend quite a bit of money on it. So it's growing organically about 2 to 3%. That's the growth of the market in the US. But it's adding another 5% growth from buying little operations and tucking them in and getting this real margin uplift. So in Australia, Reece trades on 25 times. Ferguson's was trading on 14 times. We're seeing these parallels going, hang on, these are effectively the same business, but my risk in equity is extremely low by buying Ferguson's. And it had a really good balance sheet as well. Again, another, like a penny, it's a penny sitting on the ground. You can just pick it up. It's going to cost you nothing. So Ferguson's, how do we find it? Well, our analysts are encouraged to look at their competitors offshore and straight peer analysis. What are they trading on? Because you want to see if there's a threat to an Australian company, it's going to come from offshore, typically. So we're always assessing where the risk lies in our Australian investments. And when you do that, you tend to uncover a few gems in that. So that's how our analysts, we give them free rein. Like the people that work for us, they just love investing and they like looking for unpolished gems, so to speak, where, you'd think that being in Australia, we wouldn't have access to management. That's been totally the opposite of what I expected, actually. What we've discovered is actually they're happy to speak to anyone because every company wants to get their cost of equity as low as possible. That means as many investors on the register as possible, bidding up the value of your equity. So we've found that we haven't had a problem. So we've got the team is well versed in looking for opportunities offshore. So FDJ came about because we looked at Tabcorp for so long, right? It came about and that came up with, this thing's listing. We should have a look at this. And then we spoke to the bankers that was Goldman Sachs that was on the ticket for this one for FDJ. And because we were in Australia, we pay quite a bit of brokerage in the street in Australia. That allowed us to leverage into FDJ and get some stock in the placement. It was fantastic, like an IPO. A small fund manager, not small, in a global sense we're small, but in Australia large, we got access to, the PIC got access to a placement in France at a pretty good price. So it's usually these things just pop up as our analysts are just looking at things offshore and they're finding little businesses and then they're going, this is actually quite interesting. And more importantly, the liquidity is really great. We can actually get set in a night if we need to. So that's how typically it's very organic the way our global positions come about.
Yeah, Vince, I think from our perspective to know that we have a manager that's looking at these domestic names and investing in them, but then looking at their global peer and then saying, wow, I think I've uncovered a gem there, and then having the ability to invest in those companies is extremely comforting. So I think that parallel with Reece and Ferguson, Tabcorp and FDJ was very interesting. Now, coming back to the domestic market, we spoke about a couple of other sectors. One of the sectors that I'm fascinated in is the AREIT sector, the Australian Real Estate Investment Trusts, and particularly commercial property. I'm talking mainly office property and perhaps retail property. Is this an area that the team at PIC have been looking at? And once again, have you invested in anything in the AREIT sector?
Yeah, it's a good question because what was really quite interesting was how the REITs, which are traditionally a very defensive sector, they performed during the first part of the corona shutdown. They actually underperformed significantly. Now, you'd think they're a stable income earner, pay out all their distributions if they're a trust, etc., and that they'd perform quite well. They actually performed, they're the second worst performing sector outside of banks in Australia. And the reason is because everyone started to think, hang on, because the economy shifted to working from home so easily, so to speak, it's a relative term, so easily, maybe companies will start to think about, why don't we keep 15% of our workforce on a rolling at home? It'll save us lease costs. We don't need as much space. So a lot of these companies went from trading at actual premiums to book value. And with REITs, you typically want to look at the replacement value, the market value of the market value of the land and buildings that is done by a valuer every year. If you can get them at a discount, that's usually a good start. They went from at market to premiums to value to significant discounts. And the market's quite efficient in that as well. The market went, right, these things, there's a potential for a market shift and a structural shift in how people work. We're going to put these things on 20 to 15% discounts to the last observed value, which would have been February, right, when the last result was done, or annually last year. So that throws up opportunities. Now, retail, everyone's known for a while that retail's been struggling because of online threats, etc. And that's a known, to quote a Rumsfeld. It is known that the retail sector's under pressure, and then they're having to try and fill space, and there's rental pressure. What wasn't known is that in the office market, that's been the best performing sector outside of industrial, like sheds, for the last 4 years. Now everyone's starting to question, hang on, maybe people don't need to have as much space as they used to. So prime locations, well, there might be risk on the rent. And we fully agree that's the case. But what's happened is a lot of the best quality property businesses like Mirvac or Dexus have traded at what we think is they're overly discounted. Okay, they've got good balance sheets. Like a company like Mirvac, which is we actually bought some Mirvac below $2. It had fallen from $3.30 to $2. It traded to $1.80. Now it's going to be a bumpy ride, Mirvac, because it's got a bit of industrial, it's got a bit of office, it's got a little bit of retail, but their retail is actually better than most. And it's a property developer, right? So it does, house and land packages. It does more traditional. That's the development part of the book. It's half the business. Now the dividend is only paid out of the passive assets, so the trust they run. They don't pay out of. So the dividend really is actually reasonably okay for Mirvac. But we like it because it's got really high quality management. They are, everyone remembers what's happening in New South Wales with the Opal Tower in Homebush. It's effectively falling over, leading to that Tower of Opal. But Mirvac are the most expensive builder in New South Wales because they highlight quality in their build price. So they're actually quite expensive because their construction methods are quite expensive. Well, everyone's they're going to have to go to Mirvac standard. So we think they're going to win out of that. That's a potential structural shift in favour of Mirvac. But that was trading at about a 30% discount to what we think its value is. Right? We think it's a $2.80 to $2, like maybe $3 stock in perfect conditions. So when it fell to that level, we executed our plan of let's buy some here. It's got a decent yield, high quality management, good balance sheet. Tick tick tick, and they've got a great track record of not losing their heads and spending at the top and not having a good balance sheet for the times like now. So we actually entered into Mirvac into basically March, April. And it's going to be bumpy. I think it's going to take 2 years for that investment to hit its straps. So we think we'll get close to that 280 level in a couple of years because we think that the office market will normalise. I'm going a bit stir crazy working from home on 1 week on, 1 week off. I'd rather be in the office. I think we all would. Or I build a man shed at home. I don't know, one of the two. But I think it'll normalise a bit and that rents may not fall as much as we think. And the economy will grow again back at normal levels. And what happens then is space will be taken up. People will take risks. People will start businesses. The economic recovery, that's how normal recovery occurs. So I'm quite sanguine on it. I actually think it's okay.
Yeah. Vince, you had a slide before of the some of the international companies that you're invested in. I know you've also got a slide of some of the Australian companies you're invested in. Do you want to elaborate on one or two of those, some of your high conviction positions perhaps, and why you own them?
So yeah, there you go. It's right there. So I talked about Mirvac before. Austbrokers is really interesting. So Austbrokers is a business. It's a broker, insurance broker for SMEs typically, and Now, everyone knows insurance is a grudge purchase. You always grit your teeth when you pay the premium. But it is a service of businesses because you need that protection. Now, an Austbrokers, those sort of business, or a Steadfast, they typically do the legwork for the SME to get the best possible coverage at as much as the lowest price they could possibly get in the market at that time. So it is more of a service company. They don't write insurance. Okay, they're a service offerer to the SME market. It's a high returning business. Like return on capital is quite high, about 13, 14, 15%. It's got a good balance sheet. We like the management of Austbrokers, and they're just buying little brokerages and tucking them in to build and it is a systems business as well. You need to be able to provide full service to these SMEs, customers, and have they'll have a panel of insurers that provide balance sheet effectively to write premiums. So you don't want to be too heavy one insurer because you get caught, and they've got a really broad panel, and they're known for their ability to write really good risk as well. Austbrokers. So it fell from $13, $14 to $8.50. This is a low capital employed business. It is literally the value of the business goes up and down the elevator every day. It's a people business. So to be able to buy a high returning business like Austbrokers, and it is a mid cap as well. So the benefit of the PIC is it can move in and out of mid caps, and large caps, and small caps, and offshore. So to be able to buy a high quality mid cap like an Austbrokers, our analyst said my valuation is $14.50. To be able to buy it for $8, $8.50, it's a laydown. So you're always trying to, in a portfolio, you're always trying to trade high quality for the same unit of risk. So if I'm going to improve my quality of my portfolio for the same amount of risk of the market, I'm going to do that every day. You're always trying to do that. So an Austbrokers is like one of those stocks we took to about 5 to 6% of the LIC, the PIC. Oz Minerals, we doubled down on Oz Minerals during the depths of the first part of March because copper, it's an industrial metal. They call it Dr. Copper because it tends to diagnose what's going on with the global economy. It tends to lead what's going on. So in March, copper had fallen from $2.90 a pound to $2.50, $2.60 a pound, cents a pound, dollars, sorry, $2.60 a pound, and it leads. So if you're trying to say, I don't want to buy copper because it's $2.60 a pound, that's the wrong way to think about it. Because the copper price will start going up first as the industrial economic activity starts to pick up. And by the time you've thought about buying it, it's too late. So we were buying Oz Minerals fell to about $6.80. And our resource analyst, in-house resource analyst, Clark Wilkins, he just came out and just slammed the table and said, this is one of the only copper assets globally, that's in South Australia, Carrapateena and Prominent Hill, that's actually expanding production, right? Escondida and Chile, they're all struggling to expand production, and they've got issues regarding the workforce as well. Whereas the Oz Minerals management have been investing in expanding production in South Australia, and they're pretty much over the hump of the CapEx phase. The other reason we bought Oz Minerals was most copper miners produce gold as well. That's where you find it. 40% of the business is gold. So we're sitting there going, hang on, we're actually buying a really cheap gold stock as well at $6.85. And, it's performed that way. It's actually, everyone's recognized the quality of the management, the Oz Minerals management. It's got virtually no debt. Again, very high quality balance sheet, so they can take advantage of opportunities. So on Oz Minerals, we took it up to about 4.5% of the PIC, the PIC, during that period, and it's performed quite well. It's trading at about $13 now. So it's one of the only global copper plays you can buy that's got expanding production, but it's going to get to a point where it's going to get expensive for us at some point. And I'm always happy to generate some franking credits for my investors for the future dividend payments. So that's another one. Again, it's a small mid-cap miner, but we're all over it because our analyst has got 25 years of experience as a mining engineer and as a resources analyst. Iluka I've talked about as well. I haven't talked about before. So Iluka, another mineral sands, zircon, rutile business, great balance sheet. It's actually splitting the business up into two, which is why we're there. It's more so if you think about it, it owns probably one of the best iron ore royalties globally. Now, what a royalty is they own a piece of access to a piece of it's called South Flank, WA. It's also owned by BHP. it's expanding its production from about 60 million tonnes to about 144 million tonnes. It's literally all of the expansion of BHP's iron ore exports. They get a royalty on the expansion, on the sales revenue. So that sits there in the business, and we think that it got down to about $6, Iluka. Again, we added more to that. The iron ore royalty is probably one of the best. If you think about your counterparty risk, it's BHP. They have to expand their production, right? And they get like a 1.232% royalty on the revenue of the expansion. So the market was refused to pay for it. It's basically going to the hardest work that Iluka would do is going to the post office box to pick up the dividend check from BHP for the expansion. And then they've got the mineral sands business, which is they're one of the market leaders in mineral sands. That is cyclical though. It is a cyclical business because it's relying on, Chinese housing. They produce paint pigment as well. So that's a cyclical business, but that's okay. With a good balance sheet, they can ride through most of the cycles. But the actual underlying real value is in this mining royalty they have, where they literally take a piece of the revenue every year and they don't have to put any money in to expand it. So we think Iluka's, like $11, $12 stock, and that the split in the company, it's the company went and sought tax advice. They are of the view that there's not going to be a tax event of splitting the company into two, which is great because you can pay away a lot of the value, and that we're going to see we're going to end up owning two pieces of paper, and we think that the market's starting to recognise that value, and that over time we're going to get a lot of, the company is basically stated out of that mining, the royalty company that's going to be called, the royalty company, we're going to get a nice big fat dividend check because the operating cost of that is literally the post office box.
Yeah, Vince, when I think about Perpetual and I think about the Perpetual processes, what doesn't immediately spring to mind is Perpetual being an investor in these resource-based businesses. So I'm fascinated to see that you have these stocks in your portfolio. A little bit of a question off cue, and we're nearly out of time, but we're seeing strong commodity prices at the moment, gold, iron ore and the like. I know it's very hard to predict commodity prices, but is that a bit of a tailwind for these businesses at the moment? Do you expect that tailwind to continue?
As I said, we tend to look back at what's mid-cycle value for commodities over the medium term, long term, etc. And you've got to just care. And then we track impending mine openings, where supply is going to come from, what demand destruction may occur because of a change in technology, etc. You can do a lot of navel gazing because if you try and rely too much on too many inputs, it stops you from making decisions. I tend to think of it as when the market prices these stocks as if there'll never be a cyclical recovery, that's when the easy money's made. Because you're going to get a cyclical recovery in these things at some point in the future. If you can buy the ones with a good balance sheet that can have an ability to expand their production, so grow volumes is really important, rather than just rely on the price of the underlying commodity, it's an easier decision to do. But there is a tailwind at the moment because the Chinese are, they're stimulating their economy quite aggressively. Most Western governments are stimulating quite aggressively as well. That's usually very metals intensive. So I look mineral sands, it's on that sort of same play, or copper, very early lead indicator. Electricity transmission networks, EVs, all those sort of industries, and Oz Minerals will benefit from that. But you're right, there is a bit of a tailwind now. The market will get stupid though, and they'll price it out to a point where you need 20 years of earnings or 30 years of earnings to work out. And at that point, guess what? We will have an industrial cycle to the downside. So that's how we tend to think about the resource companies at that point.
So Vince, I know you've also got a slide there on the recent performance of PIC, which particularly during the very difficult months of the market, particularly March, performed very, very well. I guess it's the final question. It's two-pronged. The performance of PIC relative to the market over this period has been very strong, and I'm heavily sensing that's because you as the manager have been opportunistic and very deliberate in your approach about looking at undervalued businesses. So as a manager right now, your outlook for markets, based on being able to protect clients' wealth really well during this difficult period, how do you view market valuations at this point and going forward?
That's really important actually, because the market's quite bifurcated. right now. So there are haves and have-nots. There's some parts of the market where they perform quite well, and the market's sort of hiding in them. They're more your defensive type assets. But the market can flip like a switch, where people will go, if there's an actual genuine economic self-sustaining recovery, they will move out of those names where there's not a lot of valuation support anymore. They're actually quite expensive, into sort of more of the cyclical names, or the recovery in activity, in personal activity, people getting out of the house and doing more things. They're still down 30 or 40% from where they were in January and February. Okay, so that's where we're sort of positioning ourselves. Is sometimes you have to trade away some nearer term performance, okay, and accept that, because you're going to get a bigger payoff down the road. And you're always, as a portfolio manager, that's what you're always doing. You're saying, listen, this has been a great ride. This company's done well. It's gone well past what we think it's worth. I could see it performing well for another month or two, but I've got an opportunity over here where I can actually buy it at a 30% discount or a 40% discount to our intrinsic value. If I don't do that change now, I'm going to miss out on some upside, and I'm going to miss out on doing really good buying. You make your money in the buying, because when you buy a stock well at a decent discount to its valuation, you don't care about daily movements because you've bought so well in the past. Now, I've said before that in 2 to 3 years' time, you want to look back at your decisions you made during times of stress, market stress, and you've gone, and you know what? We actually made some good decisions because we actually blocked out the noise. Actually, I could actually say that during the lockdown, we were all forced at home. I think I did some of my best work because I actually had less noise, just market chatter. You can actually just sit, you go back to your first principles, and you think about, what is this worth? How will this help me achieve my goals on an investment return? So you've got to make that choice every day. Like, that's what we do every day. We're making like hundreds of micro decisions with a portfolio, saying, I'm happy to give away a bit of performance in the next month for a big performance next year, because the market doesn't want to do that right now. That's what I'm trying to do. But there'll be a point, I suspect, in the next 12 to 18 months where you're going to go, you know what? I want to defend the portfolio. Everyone's getting really excited. No one, as I said to you before, everyone can forecast forever off the top of the mountain, have perfect foresight. It's time to lock the portfolio down, increase the cash level. In January, you bought quite a few options, puts on the market to protect the downside of the portfolio. So we bought protection on the downside for virtually no cost. Okay, we bought the market was trading at 63, 6,800. We bought some 5,500 puts, for virtually basis points for 15% of the portfolio to cover the downside, right? So they paid off during the March sell-off. They went to Delta 1. So what that means is they're generating cash every day for the portfolio. And we use that to equitize, and we bought stocks with that cash. There's times when you have to do that, usually at extremes though. So at markets now, we're trying to position ourselves for next year and for 22. And we probably might have to give away some performance for the next 2-3 months, but I'd rather do it today than chase it in October, November, December, because you'll be paying the wrong price for things then.
Well, it's great to know you're looking a long way forward, Vince. Look, Vince, thanks for your time today. Thanks for your insights, your expertise. It's genuinely appreciated. Congratulations on the performance of PIC in the last 6 months. We do genuinely appreciate your time.
Thank you very much. Thanks to everyone on the call.
And thanks to all our clients for dialing in. We all hope you stay safe and well. Thank you.